show you a new gauge that they're using, but let me switch to the scarcity of growth and how different the world actually is. And this gets to one of the concerns that the central bankers have. What you see on this chart is the divergence between the cyclical sectors in green, which are financials, industrials, materials, and energy, and also the growth, stability, and defense sectors, which would be tech, communications, healthcare, staples, discretionary, and utilities. And that divergence has never been as great at any point in time back to the 20s. So what this is saying is we are shaping up for a very different economy that's going to be quite different going forward, and that you have to adjust your portfolios to reflect the world that hoping for a comeback of the cyclicals requires us to be in a very different spot from a medical area, from a recovery area, and a resumption to normal activities. So resuming normal activities, whatever normal is, and we're talking about the future of everything through all these events. So the future is going to be very different. What we're not clear on as governments, as economists, as investors is what is the impact longer term of the tech adoption that's going to go on and the tech disruption that's going into every area of our society, of our government, and of our work. So something to really focus on is these divergences and the challenges of getting back to normal activities, which are quite real. So I want to also talk about the scarcity of growth from another perspective. And these last two charts are from our friends at Cornerstone Macro, Nancy's team. And this chart's fascinating. If you go back to late 99, the green line is the number of stocks in the S&P with top line growth greater than 15% for a 5-year period. And what you see today is that in the S&P 500, there's 66 stocks, or only 13% have that kind of 15% growth rates. And if you look at the Nikkei, 9 stocks, 4%, and the SOX 600, only 71 stocks, or 12%. So this actually speaks to why so much money is chasing so few investments, is so few are growing at a rate that would allow you to feel confident investing in higher multiples, because there's a significant scarcity. And I think this is part of the reason why you're seeing this move towards SPACs, this move towards other areas, is people are seeking out growth investments because they can't find it in the public markets. They're not seeing it in the number of areas in the private markets. And we're starting to see a need for new vehicles to create that. So I want to leave you with one last thought. And this is a survey that the Dallas Fed uses. It's a mobility and engagement index, and it's kind of like the Apple index, although it takes in more factors. There's a 10-factor model that they're using, but it's about time sensitivity, and it does it on a weekly basis, and it can do it on a national level for the U.S., a state level, and a county level. And if you go in the Dallas Fed, you can plug this in and get these numbers by a very targeted county around the country if you so choose, or on a state level. But what this chart is saying is we had this kind of V-shaped recovery that started to stall out, and it started to stall in the Dallas Fed's mind as we started to see reemergences of infections in different areas and the infection rate rise. And I think what we're in a period of trying to define which way we're going as we move forward. We remain positive on the outlook for the U.S. and positive on the outlook to move forward. But we also believe that what you're seeing with this stall out is this rotation that everyone was waiting for is going to be much harder to come by, and that you really need to get to a resumption of normal activities. And we're going to use this chart as one of the gauges for that. So I'll stop there, Mark, and happy to take any questions on any of this that we covered, or move on.
That's great. Any questions, comments for Stephen?
Somebody just put in the chat, Stephen, is the 15% in public company growth dollar denominated growth rate in Nikkei?
No, that was the number that on the previous chart, Joe. These stocks, it's the number of stocks that are showing revenue growth rates at above 15%. So it's not.
And so the revenue growth is okay in their local currency, like Nikkei.
Yeah,
would be the Japanese yen.
Yeah.
Okay,
and Stephen, go ahead, Sam.
One other quick question on the lower than expected inflation rates. Is the attributable reason, the dollarization of developing economies. It's really divergent from expectations, right? If you look at how much, how low interest rates we've had for a very long time, and this year in particular, we had a lot of fiscal and monetary, growth of monetary supply. You would expect higher than the 1.4, 1.8%. Is that because other sort of international markets are preferring the dollar?
I think that's part of it, but I think this has been an issue back to 2009 when Bernanke first announced QE, or even further back to the 90s when the Bank of Japan announced their quantitative easing. I think two things happened. One is what I think really truly tricked people up is when you bring rates down so low, it allows people to make investments in greater productivity, which then lowers costs for everything. And we're in a period now where it's very hard for companies to pass on costs with such financial stress in the system. Therefore, they keep trying to do more with less, and that keeps pushing keeping the lid on price appreciation or price pass-throughs. And companies are basically eating it, and therefore they have to invest more in technology to keep their unit costs down. And I think the impact of technology, when people think about tech, they're thinking about Apple and Google and Amazon, instead of thinking about the ways all these companies and new technologies, whether it's artificial intelligence, robotics, blockchain, are all reducing the cost for production. And that will allow companies to get better volumes against their competitors if they're doing it at a lower cost, and they can still be profitable with it. So I think they've misappreciated or underappreciated the impact of technology advances, which continue to accelerate at a faster rate than most people can deal with. I do think in other countries, as you talk about the emerging economies, I do think the debt burdens actually play a big part of that, because it's hard to make the productive investments. And this is the same for companies. Part of the reason why the number of growth stocks is so small is so many companies have bad financial pictures and low revenue coming in or earnings coming in, that they can't redeploy that to keep up with the tech spend of their competitors. And the further you fall behind, the harder it gets. So I think it's a combination of the debt levels and the technology and the ability to make the investments to be productive and competitive in a rapidly declining price environment, particularly as the internet of everything or e-commerce of everything grows. It becomes harder and harder. So I think it's a combination of factors. And then you also have demographics weighing a lot on the system as well. So we think those factors, and we don't think deglobalization is permanent. We think that you'll have different relationships that'll again allow pricing to be hard to come by, because there are always lower cost competitors out there. I just think it's a hard area for people to have managed to in their appreciation of it.
Other questions?
Stephen, what's the end game here? Because you have a Fed, Powell actually speaking simultaneously to you on how he wants to deal with all these things. None of it seems to be working right now. So what's the end game here? Is there a big reset coming, or something else?
Well, that's a great question. I think the end game is that we kind of play out the string as long as we can and continue to kick the can down the road, and then it's a race to the debt levels and people buying the debts that's going to keep inflation down, or do you have so much debt in the system that when you go to refinance the debt, there's no buyers and it pushes rates up. So there is a race to grow into this. And the key area of inflation right now that we're seeing in the system is in assets. So I think we're going to have to be nimble in that area. I don't think there's a time crunch on it right now. I think we're able to kick the can down the road, and just look at Japan. They've been able to do it for close to 30 years now. But I think at the end, the bill comes due for debt, and we're going to have to find a way to pay for it or write it off. Or hope the asset levels grow high enough that you can defease it, but I doubt that's going to be the case. But I don't think it's an immediate issue.
But rising that level, you want to inflate your way out of the debt.
Roger, can you repeat that?
How was
Roger, we're not able to hear you very well.
But I think if the question was how do you get out of this, one of the things is key and is the investments that countries have put off because of their financial situations. But we have to invest in infrastructure. We have to invest in skills. We have to invest in renewable energy. So a lot of the policies they're talking about are the right ones. I think the challenge is, are they actually going to do it? If you look at the US, our infrastructure needs have grown from a funding gap of 1.3 trillion in 2001 to over 4.7 trillion today. That's the gap that we have versus committed capital versus what we need to spend. And that's just to keep it in a state of good repair. Globally, the number was 77 trillion 2 years ago, and that's got to be higher now. So we just have to get coordinated efforts to make the good investments and stop wasting money on the non-productive investments. I think there's a need for a big change in how governments think about it.
So we have time for a few more, or maybe a last question before we transition.
So I have a question for you, Stephen. How about the concept of inflation? I'm led to believe, and I've always been talking about inflation being, the definition of inflation being the increase in currency units. Okay, so it's the money printing that is the inflation, and the increase in prices is a result of inflation. And we're not seeing inflation right now as measured by the CPI. And a lot of it, I believe, is because, number one, how it's the calculation and how it's measured, and what is, more importantly, what's not in there versus what is in there. So I take the approach that the CPI is not picking up inflation, but there is actually rampant inflation here and across the globe. And because we're not viewing it properly, I think the implications are very interesting, very risky, especially as the Fed just lifted their cap for the CPI level, and when they would or could step in and try to offset it, if that makes sense.
It does, and Stan Salvikson would fully agree with you. And Stan Druckenmiller, and he actually said recently that he sent a letter to the Fed saying, we seem to have inflation everywhere but in your numbers. And the guy from the Fed said, that's correct. I do think they're missing one big thing, and that's tech. And tech from the deflationary forces of tech, not just the inflationary forces. So I think there is a problem with the numbers, but I think that it works both ways. We're not capturing some of the deflation stuff, and we're not capturing some of the inflation. So I think that's part of the reason why when you look at where Kaplan's coming from with the dissent, he was dissenting that we really don't know. And we don't know if we're capturing the adoption of the implications, the acceleration, the rate of adoption of new technologies, and the tech disruption that's going on. And we're also not capturing that in ways that are more forward-looking, like the role of robotics in replacing jobs, and what does that do to lowering wages and things like that. So I think it's a tricky discussion. I bring up the deflationary forces because people seem to be leaning so far to the inflation side that we need to keep an eye on both, because it's much harder to deal with a deflation than an inflation from a government perspective.
So Paul,
Thank you.
You're new to the group. You'll see that this is a theme that keeps coming up. So you'll
Yeah, a favorite topic here for sure. Thank you.